For decades, retirement came with a predictable playbook. Work hard, save consistently, follow a few simple rules, and you'll be all set. I can actually tell people I went to school back and a lot of the books were written with that playbook and soon found out that's not the case. Today's retirees are living longer, having higher inflation, higher healthcare costs, and more market volatility. These are some of the common retirement rules that are not as reliable as they used to be. Rule number one, you only need 70 to 80% of your pre-retirement income. In the past, people would retire. They wouldn't have to buy suits for work, certain clothes for work, cut back on what they're spending in gas. But it's different now. When we're running our retirement checkup with people that come in, those projections, we always run it by what they're spending now. And a lot of times we add a little extra to it, because what we found out over thousands of plans over the years is that people just spend about the same. I mean, you just don't flip a switch and change your lifestyle. A lot of people don't retire and just stay home. They want to do the things that they dreamt about. You retire and you spend. You do what you want to do. After all, why retire? Otherwise, just keep working. And most of us want to retire. So the reality really is many retirees spend heavily in those early years: travel, hobbies, helping children, grandchildren, and then the rising healthcare costs. There are costs. They don't go away. It's life. Later on, I can tell you, when you get older, yeah, maybe the 70, 80% rule works when you get out to age 80. But right away, early on retirement, you're typically spending the same amount, if not more. Rule number two, withdraw 4%. Here we go with another percentage. So I feel like years ago, that idea of that rule was just to make it so, hey, if you're doing things yourself, just do this and you'll be okay. There are many people that wrote articles basically saying that's not true. It doesn't account for taxes, meaning if taxes go up on us, that 4% rule might not work. Healthcare costs. We could even talk inflation when I talk about healthcare costs. Prices change. So that 4% rule might not work. Market conditions. Market goes down and you're drawing 4% out. You ever hear of systematic risk? The market's going down, usually everything's going down. And as you draw, you're drawing more shares out of those accounts, so it doesn't bounce back the same. So those changing spending needs, major life events, I could go on and on. It's really about building a solid plan to begin with. You want to build a retirement plan based on your expenses. Work backwards. I know that sounds kind of weird, work backwards. But if we could work back by your expenses, take what we have for income that you're going to have coming in and then subsidize with the accounts where you saved money from, then we can build a plan and build some backups into it. This way we don't have to worry as much about those market fluctuations. Rule number three, and I've heard this so many times, your home is your nest egg. Pay off your house. Later on, you could take the money from the house. I can't tell you how many people we've talked to. And if, let's say, they're borderline with retirement based on the numbers, if you mention doing a reverse mortgage or pulling money out of the house, most people do not want to do it. We want our clients to get through retirement based on what they save, not on their house. And then the house is one of those assets that they could pass right along to their kids. A lot of times it gets there's a special tax rule, step up in basis. So when that passes on to the kids don't pay taxes on the house they inherit. So I feel like it's a nest egg to pass along, not so much a nest egg to help you get through retirement, but it could be a backup. If you do get into trouble, then yes, you can pull some from the house. A lot of times a house, it's equity rich, but cash poor. The cash is not as easy to get out of that house. One other outdated belief I'm going to add into it is paying off the mortgage. Sometimes, depending on interest rates and stuff, it's not the best move. You really want to evaluate that, because sometimes just a basic, let's just say U.S. Treasury, something that's safe, if you're making more money on that than what you're paying out interest-wise on that mortgage, sometimes you're better off not paying off that mortgage right away. So it all depends. It's an evaluation. Rule number 4. The market always comes back. I know many of you have heard that. You go see your advisor and your advisor, you had a bad month or a bad year. And the advisor just says, oh, don't worry, the market's going to come back. It's just on paper. The thing is when you're younger, you're 30, 40, early 50s, you can basically say it's going to come back. I'll be okay, because you have time on your side. And when you go to retire and you're 60, 65, it's not the same time on your side. Yes, we want you to live out to 100 and be healthy, but it's not the same time. And the reason why it's not the same time, you count on those models. You count on those portfolios. You're going to be drawing on them. So saying that the market always comes back and you go into retirement with that mentality, you don't make those changes to make it a retirement portfolio, you can get yourself into trouble. So let's just pretend you're investing risky and the market goes down by 30, 40%. You're still taking money out of those accounts. You're taking out even more shares. When the market starts to come back, you never return where you were before because you took out more shares than you needed to take out. Because remember, your share price is lower when the market goes down, so you take more shares out. So it doesn't multiply as much on the return side of it. The question is not, will the market recover? It's, do you have an income strategy that can survive while waiting for the recovery? Rule number 5, and I promise you, this is the last rule for today. Move everything into safe investments. I made it to retirement. I was advised, go out, just buy an annuity and buy some CDs and not worry about the market. Get myself completely out of the market. It's not the best strategy. If you go completely safe, you take the chance of growth out of the picture, and sometimes your plan fails. Because remember, when you go to safe investments, the return's not always the same. I can't promise you that the market's going to give you a great return, but historically, it's a mix of market and a mix of safe that gets someone through retirement. The best retirement plans are usually not built around rules of thumb. They're just a guideline to start. They're built around your goals, needs, assets, and vision for retirement. If you want a review of your portfolio, reach out to us. Just go to our website, tfcheckup.com, or click on the link below.